Thousands of transactions happen inside a business every single day. Money goes out, money comes in, sales are made, bills are paid. Yet somehow by the end of the year, we are able to come up with three clean financial statements. So the obvious question is, how do they do it? Hey everyone, welcome back to another video from Counting Nerd. In today's video, we're going to have a closer look into how everyday business transactions are converted into the financials. Let's jump right in. Think of it this way. If financial statements are the destination, then accounting is the route that gets us there. So if you want to have a more detailed understanding of what a financial statement is and who is actually using it, you can refer back to my previous video. But all we need for today is just a refresher. Financial statements are report cards for a business. They show how the business is doing financially. Anything that matters in money terms eventually finds its way to these statements. There are three main financial statements. The balance sheet, it's like a screenshot. It shows what the business owns and owes at a specific point in time. The income statement is more like a CCTV footage. It records everything that happened during the year, sales made and expenses incurred, etc. And the cash flow statements answers one simple but critical question. Where did the cash actually come from and where did it go? Each statement organizes information differently. The balance sheet splits everything into assets, liabilities, and equity. The income statement groups income and expenses in a structured way. And the cash flow statement categorizes cash movements into operating, investing, and financing activities. Together, these three statements give us a complete financial picture of the business. That's financial statements in a nutshell. Now let's come back to today's real question. If these are the final outputs, how do we actually prepare them? That's where the accounting comes in. Let's now try to understand how accounting thinks. We already know that accounting is the process that converts everyday business transactions into the financials. But the obvious question is, do we really need everything that happens in a business to be accounted and taken to the financials? Of course not. So where do we draw the line? What do we record and what do we completely ignore? And for that, we have rules. Have you seen the John Wick movies? It's a completely different world. It has its own rules and laws and everything. For example, no one is allowed to take down anyone in the Continentals. That's a strict rule. That used to be a strict rule.
No blood on continental grounds and every marker must be honored.
Accounting also works the same way. It has its own rules and laws. At first, it might feel confused or even against our real world logic. But if you step into the world of accounting, every rule is set for a purpose, for practicality and consistency. And one of the most unwritten rules is accounting is extremely selective. For something to be recorded and eventually to be taken to the financials, it has to be qualified as a financial transaction. So what is a financial transaction? Very simply, anything that happens in a business that can be measured in money. It's not the best definition you could get, but let's keep it this way for now. If money can be measured in a transaction, accounting pays attention. Let's look at some real world examples. Employees are happy because the company treats them well. The business purchases raw material from suppliers. There is a discussion going on about a future price hike. A discount is given to a customer. All of these are normal business events, but accounting records only two of them. Purchasing raw materials and giving a discount to a customer. But why? Because in these two transactions, money is clearly involved right now. The other two may be important events and even have a financial impact later, but at the moment, accounting pays attention to only these two transactions because money is involved. And with this single filter, accounting reduces the real world chaos into clean, structured financial statements. Now we know what to record, but how do we record it? Can we just write it down like we write down in a diary? Now just imagine if you're recording transactions like this. Paid $4,000 for advertising on 2nd of January 2026. Paid $5,000 to supplier on 4th of February 2026. Received 1,500 from customer for selling product number 0342 on 7th of February 2026. That might work for a personal notebook, but when it comes to business, it completely collapses because just recording is not the goal. The real goal is to look back and ask, where did we spend money? Where did we earn money? What is going well and what is not? Random sentences don't answer questions. So accounting changes the way it looks at a particular transaction. Instead of stories, it starts thinking in categories. Let's have a look into those categories next. Every financial transaction should fit into one or more broad categories. We are talking about big logical groups. So for the 5 major categories are assets, liabilities, equity, income and expenses. That's it. No transactions are allowed to float freely in the air. If a transaction does not belong to any of these categories, then accounting doesn't record it. And these categories are not random. They exist because financial statements are built this way. But organization alone is not enough. We also need control. Now we know what to record, how to record, and how to categorize them. Now pause for a second. If everything is falling into these 5 categories, how do we know that if something has gone wrong? This is where accounting introduces the most famous rule, the accounting equation. Assets equals equity plus liability. At first glance, it might look like a boring formula. Actually, it is. But this is how accounting makes sure that everything is in balance. Every transaction is recorded in such a way that this equation must still hold. So if this equation is not balancing, then accounting knows that there is some issue. Now, an important clarification. If the equation balances, it doesn't mean that accounting is perfect. There still could be errors, like a missing transaction or an error in the classification, etc. So it doesn't mean that accounting is foolproof if this equation is balanced, but it just gives you a confirmation that the structure is intact. But then how does accounting catch deeper errors? That's a topic for another day. But now just remember that this equation is not a guarantee. It's just a control. So this equation drives accounting to work in a specific way, the double entry way. Now think about it. We know that a transaction should hit at least one of these 5 major categories, and the equation should also still intact after posting the transaction. Now, if we are just recording one side of the transaction, definitely we know that the accounting equation must not hold. It will go imbalanced. So which means that we need to record at least 2 parameters when recording a transaction. Now, let's have a look into some real world examples. Purchased $40,000 worth car for business purposes. Incurred marketing expenses for $10,000. Now we know that car is something owned by the business, hence it goes to the asset category, and marketing expenses goes to expense category. Once we record the first transaction, asset increases by $40,000. The equation is not matched. Once we record the second transaction, the expense increases by $10,000. Again, equation is not matched. So just recording one side of the transaction doesn't make sense. So accounting needs a system where we record at least 2 sides of a transaction, and that system is called double entry bookkeeping. We are not doing any entries today. We are not going to explain what is a credit and what is a debit, but we now know that why double entry bookkeeping exists. Not because accountant enjoys complexity, but it is essential. Now to wrap it up, we have had a look into the business transactions. And we have learned how we can differentiate the financial transactions from the business transactions, and also how to record them and how to categorize them into different categories. And once that's done, how can we make sure that the accounting equation is intact, to make sure that the structure is intact. So today we did not memorize rules, we didn't do journal entries, we just identified how accounting filters, organizes and controls information. So in the next video, we'll step into what is a double entry, how to record a journal using a double entry, and how each transaction is affecting at least 2 accounts. Once that clicks, accounting will start to make some sense. I hope so. If financial statements are still a gray area, my previous video would be a great place to start. Till we meet again, bye.